All right, hello everyone, and welcome to the webinar of the CEE Perspective on Financial Regulation. I have the honor and the pleasure to kind of kick off this webinar series with a kind of general topic, namely how are we dealing with financial regulation? Why do we have that? Why does it matter for business and the like? So as Daniela said, what I will do is I gotta provide you with little bit of an overview of the concepts of financial regulation and the like, definitely with a little bit of a kind of critical flavor, because that typically stimulates discussions. And then we'll definitely have like 10-15 minutes for Q&As. I hope that I will be able to kind of provide you with some inspiring thoughts on the subject matter. Good. So when talking about financial regulation, then the main question is, why is the topic of financial regulation actually this big? Particularly for those of you who have been working both in practice as well as in academia, you definitely know that the past 2 decades were definitely a game changer when it comes to financial regulation. And in this respect, I would even go so far and say things have completely changed with the global financial crisis of 2007-2008. So therefore, for those of you who just want to have a little bit of a recap what the global financial crisis of 2007-2008 was all about, I found a fairly good documentary on YouTube called Global Financial Meltdown. And it's definitely worth watching it, even with some cold beer or a good glass of wine. And the reason why I'm saying that, because as you see here, it's a fairly lengthy documentary, almost 3 hours. But it is really important for those of you who are really interested in that to either learn about the global financial crisis or to have some sort of a substantial recap of what actually happened there. And what you will see is that the message that is conveyed by this documentary, that given the I would say impact of the global financial crisis, it was fairly clear that something needed to be done. The tool that was then used to kind of counter the events of the global financial crisis was financial regulation. Why is all that important? Because for those of you who have been working in the financial industry do know that let's say 30 years ago, financial regulation per se was potentially some sort of a, would not necessarily say non-important topic, but at least I would say a kind of calibrated topic, which was predominantly focusing on one main aspect, and that was investor protection. Obviously, when we have a financial crisis, which had been spanning across the globe, then obviously it is important to consider also additional aspects and rationales why to regulate. And the most important rationale that had been added in this respect was financial stability. But we will come to these dogmas then in a minute. So therefore, as a kind of kickoff, and if you have some time, definitely worth having a look at this video in order to kind of better understand some of the regulatory rationales. So when we're talking about financial regulation per se, then first of all, we have to be a little bit careful in terms of semantics, because what we typically see is that we very often use two terms kind of interchangeably, and that is regulation and supervision. Me being, among others, a lawyer has obviously a fairly straightforward view on that, because regulation is typically the activity to regulate or influence a certain behavior by issuing rules and regulations. So therefore, regulation per se is the activity of setting the necessary norms, whereas the supervision is much more concerned about the enforcement of these rules, as well as how, for example, the industry or market participants are conducting the existing rules. So obviously, as the name already indicates, when we're talking about financial regulation, then we can broadly speak about form of typically regulation, maybe as a kind of secondary aspect, also supervision, which subjects financial institutions to particular requirements, restrictions, and guidelines. The idea here is also fairly clear. We may impose certain requirements, such as that you have to be a licensed business. We may impose certain restrictions that you are not allowed to do specific things, or there may also be certain specific guidelines which are influencing the active conduct or behavior of regulated entities. And the idea is that no matter whether we are talking here about certain regulatory requirements, restrictions, or guidelines, the overall aim is that we can maintain and ensure the integrity of the financial system. Obviously, when talking about the integrity, particularly to the non-lawyers, this is a term that you may find fairly vague, but at the end of the day, you can simply translate it as the kind of stable well-being of the financial system from an overall perspective, and therefore we have different tools at hand that may ensure that. Who is typically responsible for the conduct and the enforcement of financial regulation? Well, not surprisingly, the government, and I'm on purpose here very general, because obviously it's not necessarily always the government per se, but it's typically specialized agencies such as national competent authorities and the like. It can also be a central bank. But what we should also not underestimate, particularly in the European context, that we also have EU authorities out there which are enforcing and obviously strongly influencing and shaping EU financial regulation. Examples in this respect would be the European Securities and Markets Authority, ESMA, the European Insurance and Occupational Pensions Authority, EIOPA, or the European Banking Authority, the EBA, or probably even most important, the European Central Bank as the lead banking regulator. In addition to that, we may also have certain international bodies, IGOs, intergovernmental organizations. In this respect, we can, for example, come up with names such as the Bank for International Settlements, which is also the, I would say, trigger for the famous Basel framework with respect to bank regulation, or IOSCO, the International Organization of Securities Commissions, which is more or less the international organization bundling the activities of securities supervisors across the globe. Not to be underestimated, particularly in the past couple of years, are also non-governmental organizations or NGOs. And if you just think of the regulation of sustainable finance and the like, obviously the impact of NGOs is important. May also be the same case when it's about tax aspects. So when we are talking about regulation from a very holistic perspective, it's fairly clear that regulation per se is influencing the structure of financial institutions, can also have a significant impact on its business models, the way we are interacting with consumers, so the consumer contact, and goes obviously even so far that we may even have fully regulated financial products, among others, undertakings in collective investments in transferable securities like UCITS, where financial products have to meet certain regulatory specifications in order to be issued and offered to the general public, or we may have certain pre-clearing checks by the national competent authority before financial products are actually offered. So therefore, what we can already take away at this level is that it is either the institution and its business model, or the product, the financial product, or the contact that a regulated institution has with its client, which are typically subject to financial regulation. Something that is probably not that known, but has been there for the past 20 years, roughly, is that when we are talking about financial regulation, that we typically differentiate between so-called macro and micro potential regulation. Macro potential regulation is more concerned about the overall stability of the financial system. So therefore, financial stability considerations, also, for example, the embeddedness of financial institutions into proper regulatory systems, requirements in terms of capital and the like would kind of fall into this camp, whereas micro-potential regulation is more concerned about the conduct of a particular business, which means how is a particular bank, how is a particular asset manager effectively and in compliance with the regulatory requirements conducting its business. What is also important to take into consideration when talking about financial regulation is that latest in the aftermath of the global financial crisis, financial regulation became a political issue and concern. Since I'm already very old, I even vividly remember some of the days where actually financial regulatory aspects were more related to discussions in some academic circles, but it was definitely not high on the political agenda. Obviously, due to the financial crisis, where also politicians and others had been affected by some of the negative developments in this respect, all of a sudden financial regulation made it to a certain extent even to the top of the political agenda. Why is that important? Because to a certain extent, maybe not always properly reflected in media and news documentation, is that even today, regulation of financial entities in the one form or the other is still high on the political agenda, and therefore you probably know it from your respective countries. It is not only a political concern, but it is something where policymakers and politicians are at least trying to kind of leverage on in the one or the other form. Financial regulation, in terms of its characteristics, is not surprisingly targeting the overall financial system. So therefore, it covers, among others, the payment system, which is often serves as the backbone of the financial system anyways, particularly with respect to the exchange of goods and services. It also ensures a mechanism for the pooling of funds to undertake large-scale indivisible enterprises. May also be providing a way to transfer economic resources across time and geographic regions and industries, among others, loan business, if you just think of that. Obviously, financial regulation is also there to manage uncertainty and to control risk, not only at the company level, but also in the various market segments and from an overall perspective. What is also covered and tackled by financial regulation is the necessary price information. So therefore, if you just think of stock exchange laws and the like, to have a proper price information that enables, among others, a proper decision making in various aspects. And what is also important, that's why I already mentioned earlier, that financial regulation is also kind of governing how we as industry participants are dealing with our respective clients, that obviously we are trying to mitigate the negative impact of asymmetric information and incentive problems as much as possible. So therefore, you see already by the pure, and obviously these are rather dogmatic characteristics, financial regulation per se is multifaceted. And if you add the various players which are subject to financial regulation, ranging from banks via insurance companies, investment funds to fintechs, then you see already that the combination of players plus the characteristics of financial regulation can easily be embedded in a fairly complex matrix structure. Why is all that important, and why are we actually dealing with financial regulation from an overall or a general perspective? And obviously, we only have certain limited time today, so therefore I don't want to become philosophical, but whoever of you wants to dig a little bit deeper into the subject matter, you can obviously find lots of literature on that. So the main consideration why we are actually dealing with financial regulation and why are we regulating financial institutions is the rationale of market failure. Any kind of literature that you can read on financial regulation typically starts with market failure as the main trigger for financial regulation. And that basically means that the market, in very simple terms, cannot regulate itself. So therefore, we, from an external perspective, have to kind of provide some incentives, constrain certain behaviors, or issue rules to make sure that such market failure does not occur. If you go more into the economic considerations in this respect, then market failure is more or less the inefficient allocation of goods and services by the market itself. So therefore, it kind of causes an outcome which is not Pareto optimal. Who can typically intervene in a market? Obviously, given the respective legal structures in which we are operating, or what a national or domestic legal system allows, it is that it's typically the government that is then intervening in the market. So therefore, government intervention translates into financial regulation. So when we are talking about financial regulation, and that's why I said just a little bit earlier, we can obviously have different philosophical or potentially even ideological views on that. The only points that I want to stress here is that when dealing with financial regulation from a dogmatic perspective, we typically have two main strands of thought, so to say. So we have, on the one hand, more or less the approach reflected predominantly by John Maynard Keynes, which is the pro-interventionist view, basically kind of saying that the market itself cannot regulate itself. So consequently, it is important that government intervenes. Whereas the counterposition, so to say, the market liberal view is represented by, among others, Friedrich August von Hayek, an Austrian economist who basically follows this laissez-faire principle, kind of saying, well, at the end of the day, government intervention per se is not efficient, and the market indeed can regulate itself. Obviously, the truth is probably somewhere in between. Fact, however, is when you just think of the various cycles that we have seen in global financial regulation, that we always have a kind of pendulum swinging from a kind of pro-interventionist approach to a more market liberal approach. Pro-interventionist approach is typically the response to any kind of crisis. So therefore, all the years after the global financial crisis of 2007-2008 can predominantly be characterized by a kind of pro-interventionist view, whereas, for example, years under the Bill Clinton administration in the US can be more or less characterized as market liberal times, where we also had deregulation movements and the like. If the question now pops up, where do we currently find ourselves, then we probably have a very tricky answer. I mean, on the one hand, particularly triggered by the European level, we still have a very strong dominance of the pro-interventionist view. Just think of how many new regulations may affect your respective business. Whereas on the other hand, we see at least a certain glimpse of market liberal approaches as well. We nowadays do not call it deregulation anymore, but we typically refer to technical adjustments of the regulatory frameworks. So therefore, I would say both of the strands of thoughts do exist. There is a certain overweight of the pro-interventionist view. This obviously may vary from region to region, and I'm not going that far that obviously we see different views in Europe versus the United States. And obviously this may also be triggered by, I would say, this kind of different philosophical backgrounds. Good. When talking about financial regulation and leaving aside the philosophical aspects, then whoever is interested in dealing, I would say, more details with matters of financial regulation has to be aware that financial regulation per se is interdisciplinary in nature. So therefore, it is not purely about the lawmaking or the issuing of a particular regulation. No, we'd have to consider economic aspects. What is the concrete aspect, for example, of regulating banks? What is the economic impact if we require banks to hold more capital and the like? Then obviously legal considerations. Financial regulation always has to be in line with, for example, domestic constitutional law, but also if we look at it from an EU perspective, in line with EU law out there. In addition to that, we obviously have political considerations and societal considerations. I do not necessarily want to discuss them in details because obviously we would immediately go into some political discussion either in favor or against financial regulation, but I'm pretty sure that each one of you has a particular view on that. Probably more important are behavioral considerations, and obviously, as we do know, is behaviors change over time. So consequently, also the nature of financial regulation needs to change. Which means that, for example, in the past, we may have been predominantly focusing on the stability of the overall system and the like. We may discuss these days about influencers, people who are potentially promoting financial instruments or financial investments on social media. So therefore, these kind of behavioral aspects and behavioral considerations are important. Because when I typically start some of my courses at university, and one of the courses is about financial regulation, then I typically ask students in a master program on finance, what or why do they consider financial regulation being important? Then obviously they typically come up with the response kind of saying, well, it's about investor protection. We may even have aspects of information asymmetry. And then I ask them a follow-up question, and that is, what do you find, among others, to be the kind of coolest thing in finance or the financial industry? And in this respect, for the past couple of years, I have almost empirical evidence in the sense that the answers were pretty much always the same. First of all, hedge funds are considered as being cool. Why? Because there is a guy called Gordon Gekko. And then the second answer typically is about crypto assets. What do I want to stress with these points? Well, that if we have a closer look from a financial regulatory perspective on both hedge funds as well as crypto assets, then both aspects have been unregulated for a significant period of time. And when it comes, for example, to crypto regulation, we basically have a year, roughly a year, a little bit more of experience of really operating with crypto assets in a regulated environment. Whereas on the other hand, when talking about hedge funds, we may even go so far and say, well, how do we actually define a hedge fund? And if we cannot agree on a common definition of hedge funds, how do we actually regulate it? So the point that I'm making here, we are here obviously talking about areas which are more or less at the outskirts of core financial regulation. And this is clearly also something that needs to be taken into consideration in terms of the further developments of financial regulation as a discipline. Other aspects that are more or less justifying financial regulation are systemic risks. So systemic risks are obviously risks to the overall system, where we may lose the confidence, where in the overall system, where we may see bank runs and the like. So therefore, regulation is typically also used as a rationale to kind of stabilize the financial system overall. Another rationale may be correction of market imperfections. How are we dealing with asymmetric information when we have a situation where it's crystal clear that one part of a transaction is definitely better informed than the other? Just think about yourself when you're walking into your nearby bank, and obviously you may have already a fairly good idea in terms of what you want. But then the clerk behind the counter at the bank is definitely enjoying an information advantage. Why? Because the information, also the market quotes and the like, are definitely more accurate and newer than what you have. Plus, in addition to that, there may also be a certain complexity with particular financial instruments, which may, at least for the average person, be a little bit difficult to be understood. Other rationales that we typically see, and where we have lots of literature on, is the general need for consumer confidence and consumer protection. So therefore, if you would just do some survey on the street and ask, why do we actually need financial regulation, then typically the response is consumer protection and consumer confidence, because it is deemed that when we have regulatory intervention, when we have pre-checks by a regulator, that this is enhancing and fostering consumer protection. What we should, however, not underestimate is that we may also have some so-called consumer overprotection. We'll come to that a little bit later on, and that is when we are basically swamping consumers with lots of information, which at the end of the day, they cannot necessarily digest. Other rationales include, among others, moral hazard, where, for example, regulated entities can take the view and say, well, we are only acting in accordance with the specific requirements, but we are definitely not kind of going beyond that, because we just want to be generally compliant. But that typically lacks more or less the understanding of the rationale of a particular norm. We may also have consumer demand for regulation. I've mentioned that already. And what we should also not forget, and becoming even more important, are so-called other motives, which means, among others, enhancing the competitiveness of the financial sector. Just think about EU financial regulation. Pretty much all the newest regulatory initiatives were kind of stressing that the competitiveness of the financial sector in the European Union needs to be enhanced. Therefore, we would even go so far, at least from an EU perspective, that we try at least to increase competition in the sector by means of regulation. Obviously, something that is not necessarily shared in other parts of this world, most notably the United States. In addition to that, and I think it's also fairly clear, and there's consensus on this one, that there are other behaviors which are not deemed to be acceptable in financial markets, such as money laundering, fraudulent activities, and the like, and therefore financial regulation is directly addressing those. One example in this respect could be the recently established anti-money laundering authority in the European Union, abbreviated AMLA. What are the challenges of financial regulation? Because the message that I definitely do not want to convey is that financial regulation per se is always the panacea. So consequently, financial regulation per se, also from a conceptual, but even more important from a practical perspective, has some inherent challenges. The first one can be labeled institutional aspects, namely the ability of the regulator. So if there are potentially a few of you that are working for a regulator, you may have the perfect understanding of that one, because you may potentially be constrained in terms of competences. So in other words, you may not necessarily be able to do what you want, or you do not necessarily have the powers or the tools in place. So therefore, the point that I'm making here is that on the one hand, it's fairly nice, obviously, to write on paper that we want to have, a robust, strict, and efficient financial regulatory framework. But if we do not provide the necessary tools to the institutions which are conducting financial regulation, which are enforcing financial regulation, then obviously this may have some sort of a boomerang effect, or at least create some loopholes. So in order to give you a little bit of an idea where this discussion is kind of heading to, I've also mentioned here the IOSCO objectives and principles of securities regulation, where IOSCO, the International Organization of Securities Commission, has kind of put forward some kind of generalized objectives and principles how to, just as an example, properly do securities regulation. What are the minimum requirements in this respect? And obviously, these institutional aspects range from, I would say, competences, tools, and the like, to also resources, technical infrastructure, and the like. In addition to that, and partly kind of tying into some of the institutional aspects that I've mentioned, the legal aspects, what are the statutes and the scope? What are the competences that you have, and what are the possible regulatory and supervisory actions? Why is that important? Depends on from which country you're coming from. You may have one or potentially even more institutions that are conducting financial regulation and or financial supervision in your country. So is that a coordinated approach between those institutions? Is there an overlap in terms of competences? Is there a delta where we are having, for example, certain unregulated aspects and the like? So therefore, legal aspects are important, and we can go even so far and say they become even more important, since typically national financial regulators and national financial supervisors are also kind of embedded into the overall European system of financial supervision. So consequently, an overall EU financial supervision, among others, does only work if also the weakest element in the chain has sufficient competences and powers. Other aspects that pop up on a daily basis are enforcement issues. You may have potentially clear rules, but what are the concrete powers and tools that you have as a regulator/supervisor when conducting your inspections? Can you do some investigations on the ground? If so, in what manner, to what extent, etc. So therefore, enforcement is clearly important, because obviously otherwise, if we just have nice rules which cannot necessarily effectively be enforced, then the whole thing is obviously not that impactful. What are other challenges of financial regulation? Obviously, and I've indicated that already to a certain extent, the so-called international dimension. We all know that financial markets are operating on a cross-border basis. So typically, if we are operating in the European Union, then we may have an enhanced system of cooperation between financial regulators and financial supervisors between the 27 member states. But if we have, for example, a cross-border case, let's say Austria and the United States of America, then the whole thing gets already a little bit complicated. And aside from being academic, I'm also working in a large global law firm. These are things that basically pop up on a daily basis, where we say, well, we are dealing with a regulated entity which may hold a license, let's say in the US, and wants to apply for a similar license in the European Union. Do we actually have regulatory and supervisory equivalence? Do we have similar standards? Do we actually have a similar understanding of how we perform financial regulation and financial supervision? So consequently, to make a long story short, I think it is fairly fair to say that the further we move away from European standards into third countries, the more important this international dimension becomes, and the bigger it becomes in terms of a challenge to the regulator. One of probably the hottest topics these days in financial regulation is product innovation and technology. I mean, one of the triggers of the global financial crisis was definitely some, I would say, very risky, very bold financial engineering. But if you just think of today's environment, then financial technology is definitely something that needs to be properly dealt with from a regulatory perspective. Just think of little things such as what is a fintech and how are we potentially able or not able to regulate fintechs. Do we, as, for example, financial regulators, or even more important, financial supervisors, to have the necessary technology to supervise and to enforce existing laws and regulations with respect to such fintechs? Fintechs often being startups which have a technological advantage may fly more or less under the regulatory radar. Among others, we may even have a philosophical discussion, which also very often turns into a practical discussion. Are particular fintechs actually within the scope of traditional financial regulation, yes or no? Or if you just want to be even a little bit more modest and less philosophical, just think of stock exchanges. What are you doing as a financial supervisor when some of the market participants are using technology to trade stocks in nanoseconds? If you do not have the necessary tools in place to properly monitor that, you cannot even detect potential misbehavior. So therefore, product innovation and technology will always be a challenge for financial regulation. Why? Because it's typically the market which tends to be, and market participants which tend to be proactive, versus financial regulation from its outset tends to be rather reactive. Consumer overprotection, I've briefly mentioned that one. An issue or a topic that is not to be underestimated. Why? Because particularly in the European Union, we have many regulatory frameworks in place which are there to protect the consumers, with the little caveat that sometimes we have multiple frameworks that apply to the very same situation, and they have, for example, the effect that we have contradictory information to be provided, or they have a contradictory impact. So for those of you who are more into some of the regulatory details, will definitely know that, for example, the interplay between MiFID, PRIPS, UCITS, retail investment strategy, savings and investment union, etc., a discussion which is currently very high on the agenda, is more or less reflecting exactly this problem. And therefore, very often we can kind of conclude that we may have regulatory initiatives being well intended, but poorly calibrated, and then having, to a certain extent, even a counter effect. Time, as I said, typically the regulatory environment tends to respond to market activities. So there's always a little bit of a time lag, which tends to be problematic. Why? Because if it's sunny out there in the regulatory landscape, then obviously no one is kind of concerned too much about the regulatory framework. If we have some scandals at domestic level, if we have bank failures galore, then obviously typically the response also from the public is, why did the regulator or the supervisor not necessarily see that earlier? Why did the supervisor not see it coming? And why were there not appropriate measures taken? So consequently, also the time aspect is, from a conceptual perspective, important. And just for the sake of completeness, also conflicts, among others, as an example, we may have different competencies between different regulatory bodies. What I've stressed already is that obviously, when talking about financial regulation, there is always this kind of sort of interplay between regulatory intervention and market responses. And I would go even so far to say that financial regulation can also be addressed, also from a conceptual perspective, by the interplay between government and markets. For those of you who are interested in this interplay and potentially even want to go a little bit deeper into that, it's definitely worth having a read of Reinhard Rogoff and their famous book, This Time is Different, 8 Centuries of Financial Folly, where they empirically try to examine the various financial crises. Why is that important? Because the clear message that had also been conveyed by them is that typically financial crises always tend to differ in terms of form and shape. And therefore, there is not necessarily a standard medication to kind of cure financial crisis. Therefore, it's also not a surprise that over time, the pendulum of regulation is kind of swinging into various directions, as I've mentioned earlier. What we should also not forget, and that is something that we may also in practice suffer today, is that as a reaction to the global financial crisis, we have seen multiple regulatory responses. And I would go even so far and say that the global financial crisis has more or less kind of sparked or triggered a sprinkler system of regulatory actions. And typically, if you just think of the sprinkler system in your garden, well, you know perfectly well that such a system may not necessarily be adequately calibrated, but typically when you turn on the sprinkler system, everything is wet. So therefore, pretty much the same thing applies to financial regulation. We initiated so many different regulatory responses that, for example, in certain areas, the amount of regulation quadrupled or even more, that at the end of the day, the consistency and the perfect calibration of the system got lost to a certain extent. This is something that we are struggling with in the European Union until today. Why? Because, you know, the joke anyways, the US tends to innovate and Europe tends to regulate. And there's quite some truth to that, because very often, particularly when it comes to financial matters, we typically see that the first question that we ask in Europe is, what is the regulatory embeddedness? Which basically reflects already this general notion. Are we talking here about regulated business, yes or no? And if we are talking about regulated business, how can we ensure that the particular market participant is complying with all these requirements? Why am I actually referring to all of this? Well, because despite financial markets tend to be international, we definitely do have a lack of international financial law, because there is no global or international financial regulator. And even at the European level, there is a hot debate whether we should, for example, give up some competences or push some competences from national competent authorities to European authorities. Therefore, it is also not a surprise that in the absence of an overarching body of law, that there is a lack of kind of coordinated international financial regulatory actions. And therefore, you may always find certain opportunities for arbitrage. Therefore, when we are talking about the interplay between governments and markets, it is fairly clear that latest, or especially since the global financial crisis, financial regulation has become a comprehensive and complex tool of state intervention. And until today, you see it even in financial news today, that the financial industry or certain financial industry participants have become the perpetrator of scandals and among others also the culprit of the global financial crisis. So therefore, we have definitely seen a dogmatic shift towards I would say less financial liberalization, but kind of pushing for more financial regulation, whether you like this idea or not. So therefore, despite we have this kind of setup, it is not to be underestimated that the interconnectedness of financial market remains a challenge. Because, for example, if you do some global financial transactions and you're operating out of a market which is heavily regulated with a counterpart which operates in a market which is barely regulated, then obviously there may be some opportunities for arbitrage, which typically do not necessarily help in terms of creating the efficiency of the overall system. So what are now the objectives of financial regulations? And I'm soon coming to the end, and we can then have some discussion in this respect. Well, the objectives of financial regulation are pretty much straightforward, because from a global perspective, there are two main dimensions. The first one is or the so-called transactional protections for market participants, which means we have different types of market participants which significantly differ in terms of knowledge, expertise, and the like. So therefore, in order to bridge this information asymmetry, we have typically the tool of transparency in place, which means that we require financial market participants, particularly issuers of financial instruments, to provide additional information in order to bridge the information gap between the expert or the professional and the weaker part, typically the consumer. That obviously is also intended to enhance legal certainty, among others, typically investor or consumer protection tools. That's why no matter whether we are operating from bank regulatory, capital markets regulatory, or insurance regulatory perspective, transactional protection of market participants, making sure that the weaker part is kind of protected against some potentially exaggerating behavior of the stronger party is key. This, among others, is from a historical perspective also the original objective of financial regulation, because if you just go back to the 1930s in the US, securities regulation and also bank regulation in particular were just there to kind of prevent and to limit fraudulent activities in the market. So therefore, out of the kind of notion to prevent fraudulent activities, the enhancing of transparency is there to protect investors and the weaker consumers. The second objective is the maintenance of the robustness and the integrity of the system. That is what we nowadays call financial stability. Therefore, we have particular regulatory tools in place, among others, macro and micro potential tools. And interesting to notice that both when it comes to transactional protection as well as to the maintenance of the robustness and the integrity of the system, it's all about legal certainty. And why is legal certainty so important? Because ultimately we are only becoming active in financial markets if we have a minimum trust in the overall system. For completeness sake, from an EU angle, we may also have a supranational dimension. And the supranational dimension is basically stating that at the end of the day, we are issuing financial regulations at EU level in order to harmonize EU financial markets. And latest, the attempts with respect to the savings and investment unions are clearly underscoring this notion. Good. I think that I've provided you with a few, hopefully also provocative points on some general aspect of financial regulation. As I've stated at the beginning, we will have a series of webinars covering different aspects with respect to financial markets. And therefore, it's probably also a clear sign that we kind of kicked off today's session with the topic of financial regulation. If there are any questions, more than happy to take them.